Hello, everyone. Thank you for joining today's web conference, our CNR 2025 Mid-Year Outlook webinar. My name is Rachel Crane, and I'm a Director, Senior Portfolio Manager at City National Rockdale. I'm joined by key leaders from the CNR Investment Strategy team, including CIO Charles Luke, Senior Economist, Senior Portfolio Manager Paul Single, and Head of Fixed Income Michael Taylor. The views and estimates you hear today are sourced from our investment committee's weekly meetings. During today's call, we will discuss CNR's perspective on what's in store for the economy and financial markets and the implications for client portfolios. We will look at the ongoing policy developments in Washington, D.C., the evolving global growth expectations, and other forces driving markets. At the end of the presentation, we will all be on the line to answer any questions we receive from you during the webinar, so please type them into your console's Q&A window anytime during the session. You can also download the presentation materials using the downloads window at the top of your console. I'll now turn the call over to Charles Luke of City National Rockdale.
Great. Thanks a lot, Rachel, and thanks everybody for joining us this month. I don't think there's any other way to put it. I think headlines this week have been pretty scary. I think it's easy to play down the situation that we've seen here geopolitically, especially given the outcome so far. But I'm really not going to pretend that we can just dismiss it or that the team here at CNR really can predict with any confidence what will come next. But what our expertise and our focus is on your portfolio and the market. So no matter what geopolitical strategy is being deployed out there, what we really care about is the impact to our clients financially. So what I want to do is walk through some of the market impact that we've seen and just go from there. And what I'm going to try to do is answer the question of why the situation has resulted in little more than a big shrug, with the S&P 500 now today just about 15 points from its all-time high that it hit back before we got into the tariff situation. But first, let's check in on the market a little bit and just take a diagnosis of the tone and what happened over the past couple of weeks. So first, oil, which had spiked and surged past about an $80 level per barrel, is now back down to about $65. So we're having some of that geopolitical risk premium come out of that. Second, if we take a look at gold, it's been flat, even though it usually serves as the best geopolitical hedge. And then since the first Israeli bombs landed on Iran, the S&P is actually up about 2%. And if we turn to bonds and look at interest rates, the 10-year Treasury is now about 10 basis points lower. But that drop in yields has been pretty steady. And certainly it's a far cry from where we were earlier this year, above a 4.5% level. So the drop here has been not rapid. It's been pretty steady. So why has the market reacted this way? I think first, it appears that this is all about stopping Iran from getting a nuclear weapon. And the US was the only country capable of attacking the underground sites directly. I think the other concern here was, what about a full-scale war? I think that's been in the back of everyone's minds here in 2025. But it would be unlikely in this case, based upon how China and Russia have backed away from some of the alliances supporting Iran that they'd entered into. And then Europe, while it is closer regionally than the United States, has never been that involved in Middle East affairs. So it doesn't have very much of an impact on them. What we did see as the biggest risk was the potential closure of the Strait of Hormuz. And that would have been an economic suicide mission for Iran, but it would have been likely to hurt energy prices. So we were very watchful of that. But that brings us back to today. And from the perspective of history, I think what we can learn is that geopolitical events like this have very little lasting damage on bonds or stocks. And so just kind of taking a look at what we have on this page, there certainly have been periods where volatility is created by events like this. But once you get out about 3 months and you're seeing the interest rate change on the left-hand side and the change in the S&P 500 on the right-hand side, once you get to 3 months, the impact tends to dissipate. Now, we certainly know during other time periods in history, and certainly today, we have other things that are impacting the market. But this is still a good anchor to look at when uncertainty creeps in. So the worst outcome has actually been the Russia-Ukraine conflict, which we just went through. But certainly we know other factors there, primarily inflation, played a big role in how the market moved after that. So the reality here is that no one really knows what comes next in this conflict. We won't know if these strikes were actually successful. We may never know. But it's clear that the market was able to get comfortable with the impact or lack thereof to kind of global trade and finance. So what matters more to us here at this time is the economic backdrop, the actions domestically of the administration, and the domestic response from US companies. So let's turn to that. So first, I wanted to check the risk tone, so some of the measures that sort of impute risk in the market. And then I'll walk you through our speedometers and our forecasts, and then I'll get into some of our top considerations, including our equity positioning. Mike's going to follow me with some comments around fixed income, and Paul's going to wrap us up with a deep dive on the macro side of things. So if you take a look at this slide, if you look at the top left side, this is corporate bond spreads. So this is just how much the market is essentially paying you the risk premium for going into corporate bonds. And what you can see here is that tariffs did create a spike overall in the level of corporate spreads, but those have now retreated and come back down to very low levels. So what this correlates to is that the market implied risk is very, very low when spreads are low. So that's a good sign based on a potential rise from here. We also have on the top right-hand side the VIX index and the MOVE index. So the VIX measures volatility for the equity market. The MOVE measures volatility for the bond market. Now, we did see a little bit of a hookup overall in the VIX index, but if we check it today, it's now back down to where it was on June 6th. That's a level of about 16.65. And we consider anything below 20 pretty stable. And we've seen very stable movement, actually much lower from earlier this year in bond volatility, but based on the MOVE. In the bottom left, we take a look at financial conditions. So this is the plumbing of the economy. What's really driving things from a consumer perspective, borrowing, company health. So they were a little bit higher at the beginning of the year, but they've come back down into ranges before what we saw with tariffs. And so we don't see any major issues with financial conditions that would indicate things are deteriorating or putting the economy on the back foot here. So that's another positive. And then oil and gold down on the right-hand side. Gold has been struggling to break out to new highs. I mentioned the fact that it really was stable through this entire Israel-Iran period. And oil prices, even though they're showing elevated in this chart, have now dropped back down to that 65 to 68 level. So again, that geopolitical risk kind of coming out. So I'm not waving the all clear flag here, but in the short term, I think the risk tone largely appears to be supportive of additional moves higher, especially in the equity market. So going into our speedometers, I know I've been getting to sound a little bit like a broken record here on some changes, but once again, for the month of July, our investment committee, which met yesterday, didn't have any changes. So why? Why haven't we moved it more? Well, first, we're a little bit concerned about what could happen on April 9th. That's where the reciprocal tariff deadline extension basically passes. We do expect to begin hearing much more about that over the next couple of weeks, but it's given us a little bit of a pause for concern. What we do think is a little different this time around is we know more about the Trump playbook. So we would expect him to talk very tough leading up to the deadline. But I do believe that there's a likelihood he could moderate his stance if deals are progressing and we get closer to that deadline with sort of no ultimate result. But we also don't know the full impact yet of what tariffs are going to do. They're just not showing up in the data. So it's difficult to make and adjust those forecasts when we don't have any indication of what that looks like. So we prefer to sort of stay where we are based upon our forecast today. So until we can appropriately gauge that potential impact, we're certainly comfortable holding the line on our current set of expectations. So what I do think is becoming clearer in all of this related to our speedometers is that it's fair to say that companies are making shifts. So they're taking in what could potentially happen from tariffs, and they're making those adjustments. So we do see some movement higher in cost for production, but it does appear to be evenly shared at this point between companies trying to make an effort to keep a lid on prices and passing on as little as possible to consumers. So it's being borne by both sides. So we know prices are going to go up here, but the key is really how much they will go up. And at this point, we think that's probably going to be a little bit lower than what we expected back in late March and early April. And looking at our forecasts, our forecasts so far this year have been pretty solid. We've seen consensus creep a little bit towards our ranges over the past month. And if we look at real-time GDP data for Q2, just to start here, it's actually showing an advance now of about 3%. So some of this is hard to parse given the trade noise, import-export balances, but this is a sharp rebound, and it would put us squarely in our expected range for 2025 through the first 2 quarters so far. Moving to earnings, we're pretty optimistic here. We came out of a really good Q1 earnings season, and consensus has been undershooting earnings now for the past couple of quarters. So our midpoint, the 7 to 10% range that we have, is a full percentage point above the market consensus of around 7.5%. So again, we think the market is undershooting this a little here, and we think the potential is there for corporations to continue driving profits. Now, moving on to headline CPI, we're a little skeptical of the consensus view here. Right now, year end, it's around 3%. We think that's too low. We think once tariffs are fully integrated, we're going to see a little bit of a price spike. And we think it'll gradually decline from there, not just reset immediately. And with respect to prices and inflation, I think psychology is such a huge component of this. Fears have definitely cooled from the highs that we saw earlier this year. But if you expect higher prices, I don't think anybody's going to charge you less. But in terms of that filtering through the market, I think it's likely to level out in Q4, again, as we move through this stabilization of what the tariffs are ultimately going to be. So the other component that we've been paying a lot of attention to has been measures of recession risk. So we wanted to take a look at that today on this webinar because we've developed some new tools to help us gauge the probability, both on a global basis and here in the US. So on the left-hand side of this chart, what you can see is the Ned Davis Global Recession Model. So we want to be aware of not just the probability of tipping over into a recession in the US, but we want to know what it looks like on a global scale. So the outcomes here have actually been a little bit more benign, a little better than what we've seen here in the US. So you saw it go below towards the end of 2024, about a 20% level, spiking up to about a 40% level when we got into the situation earlier this year in March. But then it went back down, and right now it's resting at about a 30% level. Now that's about 10% below where the consensus forecast for a recession is, the probability here in the US, which from the Bloomberg forecast stands at about 40%. But what is also very important about thinking about recession risk is which way is it moving, right? Where's the momentum with upgrades and downgrades? And how is the market kind of interpreting that and seeing it? So on the right-hand side, this is what's called a diffusion index. So it measures that momentum. Is the recession risk rising? Are people increasing their forecasts? Or is recession risk falling? Are they decreasing those forecasts? And so if you're above this green line, recession risk is rising. If you're below it, recession risk is falling. But right now we're right on the midpoint. So what this means is it's neither falling or rising, it's stabilized. So generally for us, somewhere between 30 and 40% is the typical probability of a recession in any period based on uncertainty and things that can happen in the environment. So I think a lot of that recession risk has now been priced out of the market. And I do think it's a core reason why you're seeing the S&P 500 where it is today. So no webinar with us at any point right now would be finished without some sort of conversation around what's happening in Washington, D.C. And so we've really zeroed in on a couple of different things. And this has been out of the headlines with all the geopolitical events that have been happening. But just to walk through some of these and give you a status update. So what's going on with the One Big Beautiful Bill? So the Senate was actually on vacation last week. They're now back. So that bill is overall being reviewed. There have been some agreements around Medicaid, some around the potential impact of the Inflation Reduction Act. But most importantly, I think what we've seen and what's the biggest sticking point is what's been going on with the SALT cap. So this is state and local taxes. And so we know that that was taken out in the previously Trump 1.0 administration under that bill. But the Senate negotiations so far have resulted in that staying at a $40,000 limit, which came out of the House. But the income limits have been lowered. So it doesn't benefit as many up the spectrum of income. And then overall, there's some fiscally conservative senators here that are looking for lower spending in general, and they're preferring a separate bill. So conversations are ongoing here. Negotiations are happening. The deadline advertised for this was July 4th, but we're likely going to see something closer to early August. Now, a very positive development has been what's happened with the China and US tariff negotiations. So about 2 weeks ago, again, negotiations happened in London between China and the US here, and they restored trade from where things had sort of fallen apart based upon that first meeting in Switzerland. So right now, that China tariff stands at about 55%. That's an increase of about 35% from their previous tariff level of about 20%. But I think most importantly, some of the shipments of the rare earth minerals and metals and magnets have actually resumed, not in full, but that flow is sort of back into the market. So overall, some positive movement on the China and US negotiation front. What we're also starting to see a little bit more of are the plans for deregulation. So just yesterday, we saw the easing of the supplementary leverage ratio. So that's just a leverage ratio of bank capital, things they can or can't have on the balance sheet. So they're relaxing those restrictions to include treasuries, which has been a big complaint from banks to be able to intervene in markets when things are getting a little bit more volatile, especially in the treasury market. We're also seeing a focus on regional banks, so potentially raising some of the threshold limits they're exposed to and eliminating some regulations that are there. And then, of course, pro-business policy just generally. There will be some policy conversations later this year about the potential to re-accelerate M&A activity across the economy. And then the last thing, we mentioned this earlier, but ongoing reciprocal tariff negotiations. We know the deadline there is July 9th, so we're going to be watching that very, very closely over the next 2 weeks. And I do think that that is a source of potential volatility as we get closer. But ultimately, we could see an extension of that, but I think it's going to lessen a little bit from what we saw on April 2nd. So getting into the global dynamics and overall returns, I wanted to level set across what's been happening in the US and what we've been seeing in non-US and global markets. So I think it's no surprise if we look at year to date, which is the second column on this chart, we're in a situation where the US has underperformed broader non-US and specifically Europe, excluding the UK. So it's definitely run up globally on us a little bit. If we go back and look at the bottom on April 7th to 623, so this doesn't include the past 2 days, but pretty much similar and the same. The S&P 500 has actually risen off that bottom about 19.4% relative to Europe, up about 19%. So the way to read this is, we're looking for entry points. And everything happened so quickly in those 2 months between February and March that it was difficult to trade that move. But we didn't want to jump headlong into any global move before we had a reassessment of how those economies were going to move going forward and how the interplay between returns was going to work. And so far, it's been equivalent. So we really haven't had an advantage to being in Europe or to being in US off the bottom on April 7th. And we continue to look for growth, currency moves, and geopolitical events. That's the core to our thinking around investing outside of the US. And to create a little bit of a corollary into the debt situation that we're seeing, what's really important to understand is, debt at this time, it just isn't only the US that's having a problem. So if you look at some of the most popular regional allocations of the best performing countries so far this year, they are spending and their debt to GDP ratios are rising, and in some cases equivalent or exceeding that of the US. And I think specifically in Germany and China, that spending is going to be picking up. We've seen that in Germany. We will see it with defense spending, and certainly with China, they've definitely opened up the purse strings for monetary stimulus, so that's taking their debt up. So it's not a US only problem. And here's the bottom line when we talk about debt. Leverage has fueled growth, right? It's fueled returns. It's created a tailwind to a lot of what we've seen in our portfolios. And the entire reason that Europe has become attractive here is because of that spending. And there absolutely is a tipping point. So I'm not saying that you can spend forever and everything will be okay, but I don't want to put us into a situation where we're only calling out the US as the only country with a debt problem. This is something that is a little bit more widespread. And I think the key to remember here is that markets can move positively even in an economy with debt. So to tackle this, it's going to take a combination of spending cuts and economic growth to get out of the situation. It may even take a little bit more weakness in the dollar, as we've seen so far this year. But what we don't think is that we're on a collision course with disaster here in the US. And it's also important to remember that without an extension of the initial Trump tax cuts and the big, beautiful bill here, it's going to be a tax increase on consumers and businesses. And that may be the worst time to hit both consumers and businesses with that increase in taxes. So there's a balance to what needs to be considered here. The other component of this chart, if we go on the right-hand side, is year-over-year consensus forecasts for both the US and then across the Eurozone. So you can see the United States, with the exception of actually Spain, exceeds growth rates across the Eurozone in every period, going through 2025 to 2026 and 2027. Now, there is a general convergence between Europe and the US, which is a real positive. But again, we're still looking for sustainability to those non-US growth rates. And that is going to be key to leading us to an allocation moving forward. So turning to the equity strategy specifically, what are we recommending? What are we seeing across sectors and how are we positioned? So let's start with our overweights. First, we are overweight technology as our highest overweight at about 1.3%. What are the reasons for this? So first, we see chip sales that have continued to soar on data center build out. We've also seen companies spending heavily to integrate AI, and I've got a great chart on the next slide that I'm excited to show you about that. And then in technology, we've seen that there's low valuation sensitivity. So even though some of those valuations are high, the market generally has a much lower sensitivity to those valuations. Now, that being said, valuations across the Mag 7 have actually improved in many cases. So it was an opportunity to be able to add to technology when we had the pullbacks back in April. Now, the second highest exposure we have on an overweight basis is in consumer staples. The reason for this is just given the environment and the backdrop, they are more economically resilient. They do outperform during instability. So it's sort of a key stable component of the portfolio. And then some of the decline we may see in real yields because of inflation makes some of these dividend payouts a little bit more attractive. And then it's not following consumer staples. We've got communication services and healthcare, but I did want to highlight energy, especially because of everything that's happened over the past couple of weeks. So energy to us is the cheapest sector, and it's arguably got the best potential inflation hedge. And it's also just valuations are very, very attractive. So we've liked being overweight energy, and that's paid off. As month to date, it has been one of the best performing sectors. Now, shifting to some of our underweights, our largest underweight is coming in financials. So we think financials are susceptible to additional Fed rate cuts. That sort of hurts their profitability. We also think they're subject to adverse tariff outcomes that could cause consumer credit losses. So that's a consideration. And then there are expensive valuations if financials have run up here, and the potential for wider spreads puts them on the back foot. Now, in utilities, this has been a great trade with respect to AI and how it's filtering through for energy demand, but valuations have climbed substantially. So it's getting very expensive. And we do think above average inflation expectations in this case, and a steeper curve, so that means higher longer term rates, could potentially hurt rate sensitivity of the sector. So it's not our favorite. And then consumer discretionary, just to make some comments, because it's been in the crosshairs here, and certainly tariffs impact consumer discretionary the most. But we do think it's at risk if consumers cut back on spending or the job market does weaken. We also think it's the sector that's most at risk from tariffs, and we've certainly seen that in how its market returns have moved this year. And we do see some expensive valuations as well after we've gotten this Q2 rally. So moving on to why technology and taking a look at AI. So we're in the second phase of AI. We think it's accelerating. So on the left-hand side here, this is information processing equipment. So you can see the big spike here we've had in overall investment in processing equipment. And that's driven by companies integrating AI and the need for additional components and how they want to organize it at their firms. The other component of this is US construction related to data centers. So in 2024, that hit a high at about 340. In 2025, it's about 140 so far year to date. And that's a run rate of about 280. So we think the AI spending narrative here is alive and well as we move forward in 2025. And the last thing that I wanted to share with you today was a little bit of a look at credit quality and health. So just what's the underlying backdrop? Again, I mentioned financial conditions at the beginning. What's the lubricant? What's keeping the economy afloat? And it really gets back to credit. So what you're looking at here is the Conference Board's US Leading Credit Index. And if you can see those blue gold lines, let's talk about what tends to happen in the S&P 500 when we're between those lines and outside of those lines. So when this is above 0.5%, that top gold line, the S&P 500 tends to have annualized performance that's flat, about 0.2%. And that happens about 27% of the time. If we look at between the bands, so this is between negative 0.3 and 0.5, it tends to annualize at about 15%. Now that happens about 22% of the time. And then below negative 0.3, it annualizes at about 10%, about 52%. So in a vacuum, just looking at credit conditions and tailwinds, being between these two lines and sort of in this core exposure is the best opportunity for S&P 500 returns going forward. So we think the environment is still very positive overall for the S&P as we move through Q2 and get into the beginning of Q3. So to summarize everything and go back through the key points, geopolitical tension did reach a crescendo, obviously over the past 2 weeks, but markets have taken that in stride and volatility measures have declined. And we think about our forecasts, they've remained stable in July and measures of recession risk have fallen. We're looking at the passage of the budget reconciliation bill, deregulation and tariff negotiations as some of the biggest domestic goals of the administration and keys to watch for the economy moving forward. And turning to returns and thinking about the global market, off the April 7th low here, we've had equivalency between what's happened globally and what's happened in the US. even as dollar weakness has continued. So that's a positive in our minds. The US is not the only country with a debt problem. Its forecasted growth rate does remain the highest in the developed world, but certainly we're not dismissing it. We're going to have to come up with an increase in growth and cuts in spending to get to the right side of that equation. Think about our equity strategies. Our overweights are in technology, consumer staples, and energy. We have an underweight in financials, utilities, and consumer discretionary. And security selection within our portfolios actually remains slightly conservative. And then the last thing is that corporate spending remains constructive in investment for AI, and that it is expanding across the S&P 500. And then credit health, as we demonstrated on the last slide, shows no signs of deteriorating. So a pretty good backdrop as we move into the second half of the year. But I will stop there and I'll pass it off to Mike Taylor.
Great. Thank you, Charles. And hello, everyone. So I'll start today by looking at the global fixed income returns. So the first half of the year has really been quite volatile as the markets have had to respond to evolving changes in trade and economic policy. And along the way, we've seen the 10-year Treasury approach 5%, drop to close to 4%, and it's currently at about 4.3 today. And that's about 25 basis points lower than where we started the year. And so despite this volatility, we're seeing positive returns across major fixed income sectors. So for example, global investment grade and high yield have been the best performers this year, with performance driven primarily by a weak dollar. And then this is followed by domestic corporates and treasuries. And then you can see municipals are slightly negative. And we'll dig into this underperformance a little bit closer. And so, although we've seen positive returns this year, concerns continue to linger around the bond market about deficits and debt. And so if we look at the chart on the left, we show the growing size of the federal deficit as a percent of GDP. And this is really the amount of borrowing that's needed on an annual basis. And so effectively, we're growing the debt faster than the economy, and debt continues to increase. And if we look at the yellow line, this is where the Treasury Secretary and economists would like the deficit to be. And this is what's considered a sustainable level for the economy. And so as we look at the reconciliation bill making its way through Congress and the projected deficits over the next several years, we think this is one factor that is likely to keep a little bit of pressure on longer term rates. And then on the right, you can see interest payments as a percent of GDP. Now, these are running at about 3%. And here again, markets are concerned about the Treasury supply that's needed to support this. But I think it's important here that we need to look back historically, and we need to see that we've been here before. So this isn't necessarily a new story, and at some point, Congress is going to have to deal with it. And so these credit market concerns are reflected in Treasury yields. So in the dark blue line in the chart on the left here, it shows the 10-year Treasury, and we can see that yields have trended higher since the election as investors have been anticipating higher deficits. And the yellow line shows another factor playing into longer term yields. And here we're looking at market-based inflation expectations. And we can see that they have recently increased, and they're likely to have an impact on rates over the near term from this combination of tariffs and energy prices. And we can pull this together by looking at the term premium. And the term premium basically tells us the extra yield that investors are requiring to hold long-term bonds due to some kind of uncertainty in the markets. And we see that it's been rising over the last year. And this helps us understand changes in the 10-year that are not tied to short-term rates. And so despite this uncertainty, we still see value in the 10-year, and we expect it to trade between 4 and 4.5%. And this is going to be driven by higher deficit spending, impacts from policy, relatively well-anchored inflation expectations, and then this potential for moderating economic growth. And so if we turn to the credit market or the corporate credit markets, both investment grade and high yield credit markets have been through a little bit of a ride this year. And as Charles had mentioned, spreads moved materially wider early in the year. And a lot of this was dependent on policy uncertainty. And then we've seen them retrace, much of that move. And so, as I mentioned, the corporate markets have ended the first half of the year with respectable returns. But as we enter the second half, while we do face some uncertainty here, aside from a few segments of the market, credit quality is actually in a pretty good place. And so the two charts on this page show that corporate balance sheets actually remain pretty healthy here. So on the top chart, we want to see lower being better, and this indicates that leverage is moderated and remains manageable. In the bottom, higher suggests better interest coverage or the ability to service debt, and this here remains near all-time highs. So even though we see valuations in the corporate markets as relatively full and reflect the strength in the investment grade markets, we do see value in the space and like the nominal yields that we're seeing in the market today. Now, turning to the muni market. So as I mentioned, this was one of the outliers where we've seen some negative returns this year. However, if we look at the charts on this page, we can see the story is a little bit more nuanced. And so on the left, we show returns across various maturities. And you can see positive returns out to about 10 years, and then the market turns negative. And on the right, we show 3 muni indices. And we can see that an index with a basket of bonds with maturities ranging from 1 to 5 years has outperformed longer duration. And it's really just the broad market with exposure to the longest maturities that has underperformed this year. And so if we look a little closer, the dark blue line here shows the municipal yield curve at the beginning of the year, and then the light blue line shows where yields are today. And on the bottom of the graph, we graph the magnitude of this move, and you can see that yields are lower out to about 7 years, but they're much higher as we move out the curve. And so what's important to note here is that what we're seeing in the muni market, it's not a reflection of deteriorating credit. So spreads have remained tight, credit fundamentals are strong, but what we're seeing here is the curve has shifted higher around the tariff announcement as broader market volatility picked up. And as other markets started to recover, muni buyers so far have really just been focused on their preferred habitat. And what that means is they tend to focus on those shorter maturities on the curve. And what this has done is this has helped push yields down and valuations up a little bit on the front end of the curve. And so as we look across the market, we do see opportunities from this. We see a favorable credit landscape, we see attractive valuations and yields, as well as good supply in the market. But more importantly, what we're seeing is a steep yield curve. And this allows us to achieve higher levels of tax-exempt income as we move out the curve. And so it's important to remember here that short-term returns can vary, but long-term returns, they tend to anchor around starting yields. And so in the market today, we see this as an opportunity to really achieve nice, attractive tax-exempt yields. And so as we look to the second half of the year, we do continue to forecast 1 to 2 rate cuts this year, and for the 10-year to trade between 4 and 4.5%. For investors that have been enjoying high cash yields, we do continue recommending some maturity extension where appropriate, as cash is starting to underperform a little bit. And we're also avoiding the very long end of the curve where we have seen a lot of volatility. In terms of the corporate bond markets, we continue to see good yields and decent value despite the fact that spreads are relatively tight. And those yields are supporting good income potential moving forward. For municipals, we do see opportunities with the steep curve and again, good credit quality. And then in the higher yielding opportunistic segments of the market, it's a similar story with good credit fundamentals and reasonable leverage. Coverage ratios and defaults are expected to remain at or below historic averages. And we see opportunities here with yields starting in the high single digits. And so to summarize, the key takeaways here, fixed income returns for the most part have been positive this year. Concerns about the reconciliation bill and deficits are one factor likely to keep pressure on long-term rates. Credit remains broadly healthy, and municipal underperformance has created opportunities for investors. Overall, high starting yields remain attractive, and we think will continue to cushion volatility. Thanks, Paul, and I'll turn it over to you.
That's great, Mike, and thank you. I appreciate that. That gives some good, interesting background in terms of what's going on in the financial markets that's being impacted by what's going on in the economy. Just to start off with the broadest view of what's happening with the economy, we continue to get a lot of questions regarding the first quarter's performance where it was negative. That just gets a lot of headlines. The numbers were revised this morning, and so we have that in the deck here. And just to review about how this works out, some of the mathematics behind the GDP calculation. I think first and foremost, it's important to realize that negative GDP reports, they're not normal in an expansion, but they're not abnormal either. Since 2010, this is the fifth quarter that we've had where there's been a negative GDP report on a quarterly basis at a period of time that wasn't a recession. But as you can see on the left-hand side, that decline that we have, the newly revised one at 0.5%, is broken up from four major categories. You may remember your Econ 101. GDP is calculated by the amount of money spent on consumption, on investment, plus government, plus net trade. Net trade is defined as imports and exports. If something is exported, that's a positive number. If something is imported, it's a negative number. And that's what happened. I mean, in the first quarter of this year, we just had a tidal wave of imports as many businesses in the United States wanted to bring products into the United States before what was expected to be some tariffs put on by the administration. So that's what this is reflecting. Again, the math is simple. If it's an import, let's say we imported $100 million, that's a negative into the GDP calculation. But if in the same quarter that imported product goes into inventory, which is part of the investment group, that would be a positive 100. They completely offset each other. Not all of that happened last quarter, so we have some carry through that will happen in the second quarter of this year. Just to continue that a little bit more, in terms of the process, if that imported product is then sold to the end consumer, what ends up happening is the investment falls by that 100 million, and the consumption part goes up, assuming there's a profit in there, let's say 110 million. What ends up, that's a positive. So what ends up happening is net, the 10 million profit is what goes into the calculation. There, I just gave you everything you needed to know to be the most boring person at a cocktail party. Anyway, over on the right-hand side. So what does this mean? Well, economists tend to, when these sort of things happen, look at averaging quarters together. Over on the right-hand side, the column is the quarterly change that we see in GDP. The dark blue line is the year over year. The bright yellow line that you see there at 1.8%. That, for the Fed, that's the ideal rate of growth for the economy, because that sort of rate, they feel, doesn't create much inflation, but it creates enough job demand to keep the unemployment rate. So that's the ideal level. But if you average the first quarter along with what the Atlanta Fed is expecting for growth in the second quarter of this year, which is 3.4%, you're going to come up with a rate of around 1.5%. So not nearly as strong as what we have been seeing the previous few quarters, but it's pretty consistent with what the Fed would like to see in terms of long-term growth. Another thing that the economists look at is really what is the underlying demand for products and services of what's going on in the United States. That's most important to them. Yes, there are other parts of the calculation that in the long run is important, but they create an awful lot of volatility that has really nothing to do with economic demand. So they have a number that they call the final sales to private domestic purchasers. And on the left-hand side, it just breaks down how they get to that calculation. But the important issue is what's left over. What they're measuring is consumer demand, consumption, which is almost 70% of GDP, along with businesses' investment, taking out the inventory part, which is about 19%. So in net, we're looking at 85% of GDP, but it's measuring just the domestic demand. It takes out the inventory swings that I just talked about, takes out the net trade numbers that I talked about, and it also takes out government, because government has nothing to do with domestic demand. The important issue here is if you look at the chart, the quarterly changes in the column and the year over year is the line, and you can see it's been relatively stable and quite strong for the last 2 years. And that's really what keeps economists quite optimistic about the economy, is because the underlying demand is very, very good. You know, you can think of this as like You're normal and healthy, but you do have that crazy brother-in-law. That's not all that other stuff that I just talked about. The economy is doing just fine, but of course, there is some uncertainty about the future, and that is a concern. One of the biggest issues in terms of what we read in the news, especially in regards to the Fed, is the risk of inflation, especially with tariffs coming on board. Now, the news on inflation has been quite good. On the left-hand side is the consumer price index. The column is the monthly change. The dark blue line is the year-over-year change. And you can see the last few months, the monthly change has been quite low. To get a target inflation rate of 2%, that means the monthly number has to be 0.165, so slightly less than 0.2%. And we've been having that of late. If you look over on the right-hand side, it's the breakdown of those numbers in terms of what we're seeing. You can see the year-over-year number, and of course, what's been happening in the last 3 months. And that's annualized. You can see all the major categories have been on a downward slope. That's good news. That's why some people say the Fed should be lowering interest rates, but the Fed is not concerned about recent history. They're concerned about the future. And that's why they're holding off. They just want to see how things play out. In terms of the tariffs, it's an enormous tax, as Charles talked about. In terms of dollar terms, it's expected to be the biggest tax in our history. But how is that going to work out? How much of those tariff costs are going to be passed on to consumers? How much is that going to be absorbed by businesses, which means a reduction in profitability? They don't know, and that's why they continue to be sitting on the sidelines here. But they also have some concerns. Part of it is the fact that tariffs have yet to have any impact on spending yet. Most of what we're buying right now was products that were imported or created before tariffs were put in place. But businesses know that things are going to happen in the future that they see long before the end consumer sees. So on the left-hand side, we're just looking at the information from the ISM. This is the data that comes out at the beginning of the month for both the manufacturing sector and the service sector. And one of the components that they look at is prices. And you can see that both the manufacturers and service sector are expecting prices to be moving up. In terms of the delay of tariffs, it's hard to see and make those predictions in the future, again, because we don't know what the tariffs are going to be on, how much they're going to be. What we can do is look back in history. What we know is the president put on a 25% tariff on Chinese-made washing machines, and that was in 2018. The chart on the right shows that. The vertical bright blue line that you see there is when that was put in. The Consumer Price Index, which has a component called laundry equipment, which is both washers and dryers, you can see how that has performed. The line is the year-over-year change. The columns are the monthly change of the 3-month average. That's, of course, annualized for easy comparison. For the 2 years before that tariff was put in place, laundry equipment was falling at about 5% per year. Once that tariff was put in place, what ended up happening is a few months later, 3 or 4 months later, we start to see the price increases. And it got up to be about 15%, which is interesting. And this is exactly why economists hate tariffs, because of how inefficient they are. The tariffs were on just Chinese-made washing machines, not dryers, but retailers, using it as an opportunity to increase their profit margin, increased the price of dryers by the same amount. Domestically made washers and dryers were also increased in price because they could. They didn't have the competition of the lower prices. So you can see what the impact had been on just one small sector of tariffs. Of course, this time around, tariffs are expected to be on far more products. And we don't know what the rate's going to be. Another issue that's closely watched is in terms of how much will these tariffs have in terms of an impact on the labor market. Inflation sort of slowly moves up and slowly moves down. Labor is a lot different. It tends to move much faster. We see those changes happen. One of the leading indicators of the unemployment rate is the claims for unemployment insurance. It's a nice report. It comes out every Thursday morning. Most people don't pay attention to it when they hear it on the national news. But it's very important because what happens on Thursday morning is telling us the data through the previous week. So it's very, very timely. Tends to be volatile, so we look at the 4-week moving average of that. But you can see the claims for unemployment insurance, the dark blue, leads the unemployment rate. So we watch this number very, very closely. This chart here on the left-hand side just shows the columns of the weekly change. The 4-week moving average is the dark blue line, and it's been trending up. So it is a bit of a concern. It's above the average that we've had for the last few years. It's not as high as what we had a few years ago when there was a fear of a recession, but it is moving up. So it is something we're watching. It's not at a level that's a concern. These are still really, really low numbers. Remember, the unemployment rate's 4.2%, really low. Just to put in perspective, you can see on the right-hand side where this number is over on the right in the bright blue compared to recent history. Normally, we'll be having numbers around 350,000 before what we see in terms of right before a recession. So we're in pretty good shape right now. In terms of the math, there's 160 million people working. So for the unemployment rate to move by 0.1%, that would require 160,000 people to lose their job, roughly speaking. A dollar is another concern. And this part is a big surprise in terms of the decline that we've seen this year, which is odd. One of the big issues that's kept the dollar strong for so long is, one, our interest rates are a whole lot higher than other countries. And other countries have been lowering their overnight rate. We have yet to do that. So that would tend to make money move towards the United States, pushing up the value of the dollar. Another thing is that when you put on a tariff, that tends to increase your currency's value relative to the others. Because what you're doing by putting on those tariffs is that you're disincentivizing consumers from buying products from overseas because now they're more expensive. So that means you don't need to buy that currency. So that currency relatively falls in value, making your currency worth more. Those two things should be driving up the value of the dollar, but actually that's not working. We've seen a decline of around 10%, and that's quite extreme. This is attributed to the fact that, one, the United States, which had been a strong proponent of free trade ever since Bretton Woods in 1944, had changed course. And so there's a little bit of uncertainty in terms of what exactly the United States will be doing. That said, if you just stop and think about it, this makes imports even more expensive. Not only do you have a tariff of, let's say, 10%, you also have a decrease in the value of the purchasing power of the dollar of roughly 10%. And so all of a sudden that product is 20% more expensive to be imported compared to what it was beforehand. On the right-hand side, you can just see how the dollar has performed in the open markets and also how other currencies have performed versus the dollar. Europe is probably the most important there in the aspect that we import an awful lot from Europe, about 75% more than we import from China. So again, those products will be a whole lot more expensive than what we've seen in the past. China, of course, their currency hasn't moved much, but that's a controlled currency. All the others here are free floating. On the far right, I just have Switzerland there, and mainly because that's a safe haven for many Europeans. Their economy is linked with Europe, but they're not part of the euro. They're not even part of the European Union. So that's why it's viewed as a safe haven. Another issue is spending. Spending has really slowed down quite a bit in the first half of this year. It was very, very strong the last 2 years. Last year alone was 3.1%. Over on the left-hand side, it's the most recent data we have on retail sales. And you can see the column, which is the monthly number, it's been quite volatile. And this really is tariff related. You can see the big jump that happened. That was in March, mainly because of purchases of cars before the big tariff was going to go on in April. The last 2 months have been negative. But part of that negative is, one, the drop in automobile sales, but also gasoline sales, because the price of gasoline has fallen. This number is not adjusted for inflation. But you can see on the right-hand side the changes in the major components of retail sales. So far this year, it's down 0.3% overall. But the areas that we've seen the decline, one, gasoline stations, again, because of the price decrease. Vehicles and parts, again, because of the large tariff. Building materials, well, some of that is imports, but that has more to do with the high interest rate on mortgages. The demand is not nearly as strong. And then you have discretionary spending like sporting goods and food. That's where we're seeing the decline. I think the important issue here to remember is that the slowdown in spending is not because people can't afford it. It's because they're just choosing to cut back a little bit. And that has to do with uncertainty. Well, we've seen this in the past in business cycles. It's not uncommon. And what ends up happening is once the issues are resolved, people have an awful lot of money because the savings rate has moved up these last few months because the unemployment rate hasn't moved much. And as a result, that money starts burning a hole in their pocket, and you see very, very strong consumption in the few quarters that follow these sort of periods. In terms of what the Fed is thinking, you can see here on the left in terms of their outlook for this calendar year. They did make some recent adjustments in terms of they're now expecting a little slower pace of GDP growth that you can see here. The unemployment rate will probably move up a little bit higher than what they had previously thought, mainly because of the inflation fears that they have. But the federal funds rate, they still expect to see 2 cuts of 25 basis points each. The financial futures markets for the Fed funds, you can see here on the right-hand side, the numbers that are in red, that's what they're expecting in terms of when the next cuts will happen in the Fed funds market. So they're a little bit more aggressive than what the Federal Reserve Bank is. But our outlook continues to be positive in the aspect that we're not expecting a recession at all. We do expect the pace of economic growth to slow down compared to what we saw last year. But that really, again, has to do with the uncertainty that consumers have more than anything else. A lot of that news should be resolved over the next month or two in terms of the budget plans for next year, and also in terms of the tariffs. And the government can, at that point, start focusing on cutting back regulations. An awful lot of what Charles talked about. That's very, very pro-business. So we're expecting to see a rebound in the later half of the year and well into next year. And that's it. So I think I'll turn it over to Rachel.
Wonderful. Thank you. And a quick reminder for everyone that if you have a question, you can submit it in the Q&A console. It actually looks like we have a few already. And Mike, I'm actually going to start with you because we got a handful of questions about municipal bonds, specifically with news swirling about the municipal bond tax exemption and early headwinds to muni returns. Do they stand a chance to gain ground on taxable bonds if rates stick around these levels?
Yeah, thanks, Rachel. Yeah, good question. And so, yes, there were concerns early in the year that the municipal exemption was at risk as a pay for in the budget reconciliation bill. Currently, both the House and Senate versions of the bill maintain the exemption, so it no longer appears to be at risk. The threat to the exemption, we think, did play a small part in the muni volatility that we saw earlier in the year. That did help push yields a little bit higher here. But as I had mentioned, we did see a pretty good recovery on the shorter end of the yield curve. And so if we look at returns as of yesterday on the front end of the curve, whether it's a 1 to 5 type of strategy or a 1 to 10, returns are close to 2%. And when you adjust that for taxes on a taxable equivalent basis, those returns are comparable to what we're seeing in the taxable markets. And so the underperformance that we've seen, it's primarily been driven by the longer part of the curve, and that recovery has been slower. But what we think is given the attractive valuations and the yields that we're seeing in the market, what's pretty typical in the muni market is that when treasury yields remain stable, they don't necessarily need to decline. We just need a little bit of stability. We're going to start to see investors start to push out the curve. And that's because yields are attractive. The front end is fairly valued to a little bit rich. And so as those valuations are stretched on the front end, we start to see investors push out the curve a little bit. And I think that's going to be the next step in this process here. And we'll likely see that develop over the second half of the year.
Great, thank you. Looking at other questions, want to turn it back to you, Charles. Going back to some of the geopolitical issues, markets have been resilient in the face of the escalation between Israel and Iran. How is that possible, and why aren't markets lower?
Yeah, it's a great question, Rachel, and it's something we've been scratching our heads about quite frequently over here. I mean, I was actually on vacation last week, and I saw the news on Iran kind of getting bombed by the U.S. in terms of the nuclear sites on Saturday night. And my expectations was for futures to open a lot lower on Sunday night, but it just didn't materialize. And so I go back to a couple of comments that I made earlier But I think what this is about is isolated. And that's about Iran getting a nuclear weapon. And so that was a little bit easier to parse out in terms of this conflict and the aims, in terms of what started it. And the US was the only country that was capable of attacking those underground facilities. So I think that's why we saw that. The other concern, and I think this still remains in the environment, but with respect to this conflict, it's a little bit less. It's what's the risk of a full-scale war, right? So bringing China into it, bringing Russia into it, and certainly the alliances that had been there with those two countries in Iran were of concern. But it became clear very, very quickly that China and Russia did not step in to support Iran, and they backed away from the situation. So Iran was pretty isolated, and I think that helped markets get beyond just the immediate aftermath of what happened and to focus more on the fundamentals and the run that we've been on. And then with respect to Europe, we didn't see much movement at all. And they're much closer regionally to the situation. But again, they haven't been that involved in Middle East affairs over time, and they certainly don't source a lot of their energy needs from the Middle East. So there wasn't direct exposure there. So because of that, the broader market, global relationships, and just how the puzzle fits together, it didn't look like it was going to be majorly impacted. The biggest concern was the Strait of Hormuz and the potential closure there, but we got quickly through that, and of course that didn't materialize. So we're sort of through it now. There's a ceasefire. We don't know what the next steps are going to be, but ultimately, I think those factors really drove the market moves.
Great, thank you. It was surprising to see how little it was impacted. Good to get the insight why. Paul, I'm actually going to move to you to get an economic question in here. What is the probability of not only entering a recession, but entering it with higher levels of inflation?
Well, that one of the things a recession does is cure those problems. I mean, it's happened many times because what ends up happening, inflation gets to be a little bit too high. The Fed starts cranking up the federal funds rate to slow down demand, and they do it a little bit too much and too quickly, and we fall into a recession. I mean, that's what the cause of most of the most recent recessions have been. This time around, the Fed is somewhat restrictive right now in terms of monetary policy, but we don't see inflation as being much of a severe problem. Yes, the dollar trading off. Yes, the tariffs will add inflation, but that's sort of a one-term shot, and the Fed's going to look through that. The Fed's more concerned with long-term expectations of inflation, and we've had charts about this in the past. That's their biggest concern. They don't want to change the behavior of the consumer. Now, most people on this call aren't old enough to remember the 1970s and 80s, but that was a big part of the decision-making process. Do I buy a car now or do I wait a year and it's going to cost 15% more? Well, people tended to buy the car now, and that increased demand, which increased prices to move up. The Fed doesn't want that. We've been without that for more than 20 years or so. So they're trying to push down what the long-term inflation expectations are. The financial markets don't see it as a problem, but when you look at the survey data, like the University of Michigan, which is probably the most popular, you see much higher levels. That said, it has been coming down, so that is something that's very helpful for the Fed. So the risks of moving into a recession at this stage, we think, is extremely small. And if it does, then the Fed can easily cut interest rates to increase demand, because interest rates are probably 1 to 1.5 percentage points above what they consider a neutral level.
Great, thank you. And that wraps us up here. Thank you all for joining us. A brief survey will pop up shortly in your console, so please share your feedback and suggestions for future topics. A replay of this session will be available within 24 hours, and you'll receive an email letting you know how to access it. Have a great day, everyone, and thank you for joining us.
Thank you. Hey.